Morning, everybody, and welcome back to the Weekly Standard, or the Market Standard, rather. My name is Dineo, and I hope everyone is safe and warm and very ready for level two, where we will finally be able to see our family members and get some alcohol and cigarettes and, go on holidays. It's 144 days now of lockdown. And despite all the great and amazing ways that we can now go out, some of us are still going to be very um, safe and sound indoors. Before Simon joins me, and he's on the line, I just want to make sure that everyone can see me or hear me rather. So if you can hear me, just indicate by lifting your digital hand. It's the little hand icon. Right, I see quite a few hands. Simon, morning. Welcome to almost level two
Morning,
of
Daneo.
lockdown.
And also almost spring, although apparently a cold front coming. But I'm totally prepared for level two, and truthfully, I'm probably just going to mostly stay at home, although I will buy some cigarettes and I will buy some more wine and whiskey.
Yes, definitely. It's those ongoing conversations where I think I'm very excited for anyone who's going to be going out because I think, it's been, geez, 144 days indoors. Like, people are allowed to enjoy themselves. However, I think being the hermit that I am, at first when lockdown began, it was a bit of an issue for me because we weren't allowed to go out. So obviously, the thing you want to do when people tell you you can't
Yes.
do it is you want to do exactly that. But now, I'm like, I'm not sure I want to go to the office and I'm not sure I want to go anywhere. Not because I'm scared of COVID, but because actually I really like being indoors.
Well, yeah, it's partly. I mean, it's partly COVID, right? Because it's still out there. It's way lower than it was at its peak, but it's also, let's not kid ourselves, way higher than it was when we went into lockdown in March, April, early in the year. But it's also, I'm so productive, and like having to drive places is such dead time, and I'm not looking forward to that. So yeah, just tell people you've been exposed, and therefore you're isolating until 2021.
Yeah, and I think there's just a certain comfort. And I did say to somebody, having to wake up and go to the office now, that is starting to do this is going to be so different because my morning routine, I think, yeah, I mean, I still wake up, you get up, you shower and everything. That rush to get to the office is not quite there. You're not thinking about the outfit you're going to wear for the day. Like none of those issues are, top of mind. You just grab whatever's comfortable and you
Hmm.
sit at your desk. Your work day starts a lot more smoothly. So
Yes.
I don't know. I'm just feeling a bit like, now that we can finally sort of kind of do things, I'm not sure I want to do things.
Yeah. No. Agreed. Hmm.
But yeah, perhaps let's kick off and start chatting as always, looking at the US. And we had retail sales for July coming out, and still improved, but a lot slower. I think people were expecting about 2.3% uptick, and it was only 1.2% in July. And when we strip out car sales, I think sales did beat consensus, but still, I think that's a big slowdown, I suppose. While it's increased, it is quite, a bit we'd like more from the
Yeah.
American economy. But yeah, maybe let's chat about that and chat about the fact that for the first time, also in weeks, we finally got jobless claims coming in at below 1 million, which is amazing. And I think and not surprising, but still, given just the shocking numbers we've seen, it's sort of a bit of a relief to see that number slowing down a bit.
Yeah, so I mean, I think you're right in the retail sales. I mean, they're disappointed, but I think that expectations had really run ahead of themselves. You know, we had 7.5% in June, and we've been saying on this podcast now for a long time that that April. And to a lesser degree May really marked the absolute worst low point of the lockdown, which has pretty much been global. And retail sales are picking up, and a positive number is still a good move, but we're hitting that plateau. And the other, so increases are going to be sort of slow, steady, but small going forward. And I think the other plateau, which I know I mentioned repeatedly, was we just couldn't get above or below the 1 million jobless claims. And finally, we came in at that 963,000. It is still a humongous number, still well ahead of the previous worst week, which was the crisis of 0809, when I think they clocked 680,000, but well down from the 7 odd million. It's now 21 weeks before we've seen those numbers below 1 million. And it shows the evidence that there certainly is a slow sort of reversal back to, and I don't want to say normal because it's not normal and it's not even the new normal, back to a new reality. And that new reality, and we'll talk level 2 South Africa in a bit when we bring to the local stuff, but that new sense is that how is economies going to be operating when we still have a pandemic? And there was a great interview with Bill Gates last week in Wired magazine where he was talking about it, and his assertion, and he's not an epidemiologist, but obviously he's fairly close to this, and there's a lot of moving parts, but his assertion is it'll be the end of 2021 before broadly the sort of rich part of the world has been inoculated, and then a year later until the rest of the world, i.e. the poorer half of the world, have been inoculated against the COVID-19, which means this new reality we find ourselves in, this is going to be here for some time, and then we're going to split into sort of two halves and then merge again at the end. But it means that we need to get used to this, and part of that is getting jobless numbers coming back into a better space. I'm still very much of the view that 5% unemployment is a long way. Levels pre-low income workers who in many cases have lost jobs, and in no one's rushing off to get back to that. And of course, the huge debate around schools remains. But certainly, the trend continues to ever so slowly eke in the right direction, which is to say we're recovering from those horror months of April, May, and picking up. And we've seen that, we can touch on the next point, which is the UK GDP, which was an absolute horror show. Of course, again, that second quarter, that's mostly driven by April and May, and we've seen it across the EU zone. The UK was particularly bad. We saw the US come out with a horror number, and if we do the unannualized numbers, they're running at about 10% down for Q2. We're not going to get our data until late September, sort of second half of September. So we are ways away from getting that. But that's the part that's behind us. The question is, how do we now get out of it? And that really is going to be the key driver. And the evidence is we are. That doesn't mean that we're back to normal, off to the races, but it certainly does say sort of normal economic activity is moving in the right direction. And that's broadly good for stocks, some, of course, more than others.
Thanks, Simon. And I suppose touching on that UK GDP dip, 20%, actually 22.1%, if we're being accurate. That's a very big drop, and followed in the biggest so far, at least among the major economies, closely followed by France, but France is at 18.9%. And obviously, in a services-driven economy, which is really what the UK is, when you rely on services and you rely on household spending, and then the thing you have to impose, during lockdown is, essential cut of these drivers or economic drivers. It's gonna be an issue, but I suppose the big question, and it's the one thing we've said who knows? We're actually not going to be able to know how to respond or whether the responses were great or not until a year from now, if we're that lucky. But we're seeing these big drops. It's unlikely we'll see these drops again. However, there is obviously the concern around a resurgence, people sort of going on holiday, coming back with a second wave of infection, so to speak. So while we might not see these bad numbers again, we're still not quite out the dark. We're still, it's still the uncertain zone.
Absolutely, and I think you hit on two important points there. Let's make no bones about it. And I keep on referring back to the December 2019 numbers. Sort of pre-pandemic. How far are we away from getting back to those levels? My sense is we're still a couple of years away, and there's every chance that we're going to see. New Zealand's gone back into lockdown now. Let's be clear; they've got about 100 community cases, which is tiny, and not even 100 a day. Just 100. They've gone back into lockdown, and I think that is very much what we are going to be seeing going forward, is that seesawing of back into lockdowns. I don't think we're going to see much of the level 5 lockdowns that we had back in March, April, May. They were simply too hard for the economies, and I think governments are simply too scared to go that far back in. But it services economies. I mean, people were losing jobs, so they can't transact. People were scared to go to their jobs. UK, of course, the big story for UK for 2020 we thought was going to be Brexit. Of course, it's not. Brexit's been completely moved by the wayside, but it is still there. It is still important. And the one economy which I've been tracking a whole bunch, because it's still a large manufacturing economy, is Germany. And we talked about them 2 weeks ago when they came out with some data. And the problem that Germany is seeing is quite simply, they can manufacture their goods for export, but supply chains, can they get it into the economies that they want to export to? And are the consumers in those economies, out there and shopping and buying? And the answer is those still remain significant challenges. One thing I noted with PMI data, which is a couple of weeks old now, but of course we missed last week because of the public holiday, South African PMI data, the one thing we did see was exports actually picking up, and our major exporting partner is Europe. So Europe is moving there, but it's off that very low base. And whilst the initial bounce, and this has been my view for a while, that initial bounce was strong and robust, we're now into that slow and incremental, and it's going to take a while. When I say a couple of years, are we, and if you split it into different regions, sort of, emerging markets, Western Europe, North America, when are those regions going to be back at their December 29 levels? And I think we're looking at 2022. Even though we'll start seeing some decent GDP for Q3, that'll be the base effect, of course. It's going to be another year and a half or so before we're back to normal. And there are a lot of if, buts, and maybes in that statement around second and third waves, around vaccines, efficacy, and the practicality of producing and ultimately vaccinating 8 billion people on planet Earth, something we have never done ever, not even with the sort of the measles and the like, and now we need to do it in absolute record time rather than over decades.
And moving on, Simon, looking at China, we speaking about improvement, economic improvement. So year-on-year sales, retail sales, disappointing quite a bit. Down 1.1%, but disappointing partly because of COVID-related issues. But there's been quite a lot of torrential rains and flooding happening in China, which obviously when there are floods, people cannot buy, but also things are damaged. So that is unsurprising. But what did happen though, is car sales went up 12.3%, which is quite a big turnabout from 8.2% down in June. So we're seeing that a much needed resurgence, at least in some of the key industries. I mean, auto sales is quite big, and even in South Africa, still slowed down quite significantly. But this is sort of like encouraging. That said, I think when we think about improvement, or when we think about recovery in China, there's are multiple pillars that one needs to consider as investors. We need to think about, possible cases of pockets of lockdown happening where there is a second or third or fourth or however much waves of the virus. We need to think about the floods, but we also need to think about the US-China trade war, which is still ongoing, or trade issues. Let's, that rear their head every now and then. We think we're focusing on one thing, and then next thing you know, it's like, boom, hang on. We're still back at this. So quite a lot of moving parts, I think, under the circumstances to take in when it comes to China and recovery.
Yeah, so certainly you mentioned the floods, and we can't discount them. That does have an impact, and without those floods, we would have seen slightly better numbers. China interests me for a bunch of reasons. Of course, second largest economy in the world, and trade conflict with the US, and truthfully, Japan and India at the same time. They've got multiple fronts, but they were the first to go into hard lockdown in Wuhan. They were the first to come out. So notwithstanding they're a command economy and they're different to much of the rest of the world, they're giving us some sort of lead indicator. And what we did see as they were coming out of hard lockdown was the consumer not rushing out to the degree. Firstly, out of just concerns, but also just out of lack of confidence about their bank balance, their future paychecks, global supply chains. We've talked before around the Foxconn factories in China, which were ready to open but couldn't get the parts from all the different areas because one of those was Italy, another was Germany, and a third was the UK, and they were still in lockdown and struggling in that sense. So it gives us a nice lead indicator. The 1.1 down, if we take floods and a cautious consumer, I think probably in this part of the scenario wasn't unexpected. And I think we would probably see the same in Western Europe and North America, although when we were in the same time frame, in other words, the distance, the time from hard lockdown being lifted, the Western Europe and North America is sort of starting, we're probably around October, they're starting to move into holiday season, year end, and that could perhaps skew numbers. What stood out for me for China, and I'm glad you mentioned it, was those vehicle sales, and that surprised me. A vehicle is something typically that if you need to, you can run it for longer than you had to. You might have planned to replace your car this year, but pandemic arrived and you said, you know what, it's going to last another year or two. It will be fine. Our cars last way longer than typically we drive them for. So that to me, we've seen vehicle sales collapse, and I appreciate they were very low bases, but it's something worth watching because that has ripple effects all over. If vehicle sales start coming back strongly, that obviously has implications into steel industry, that has implications into therefore iron ore, which is Kumba in South Africa, and demand in that space because iron ore into steel, PGMs of course for catalytic converters, and then of course Tesla, who actually do a fair bit of trade in China. I want to see some more data in a couple more months to see if that was maybe just a pent-up demand. Yeah, maybe it was a case of if you were writing off your vehicle, if you were crashing it, you weren't able to replace it because of lockdown, and maybe it was just that pent-up demand that then came to the fore. But it's something that is worth watching because I really was expecting vehicle sale demand to come back significantly slower.
Yeah, I think certainly there's probably an element of, we couldn't get a whole lot done during lockdown, so let's get the backlog, especially of claims and things like that, out of the way. And I can't help but imagine that it's also a you only live once, boom, and only because I've also noticed it with a couple of people just in my circles where people are like, look, life's short, I'm going to buy the car. I'm going to buy the phone. I'm going to buy the thing that I want because life's short, and I don't know. I feel like people realized things during lockdown, and their priorities did change. And I've noticed there's almost like two extremes where people are live life because you just don't know, versus the incredibly cautious approach of, completely cutting back, completely being just like almost like military precision about budgets and really taking care of your money and just being thoughtful about what's actually happening with my money. So it's going to be interesting to see as well how the balance just sort of changes for China, but I think for everyone else. And I think as we start collecting that data, getting a better sense of what actually drives people's decision making. So will this 12.3% probably going to slow down, but by how much really, and which parts of the market are actually moving cars? Is it the lower end of the market? Is the high end of the market? What kind of consumers, new or recurring, are we actually seeing in these markets, and who's actually driving the sales?
Yeah, and is it, issues around, is it corporates, is it fleets? But you make a great point there, Dineo. If you didn't lose your income during lockdown, and that's a big if, a lot of people have, South Africa, millions in Europe and North America. But if you didn't lose your income, certainly my experience was my expenses were a lot cheaper. There was no Friday night drinks with the friends at the bar that sort of, that makes a major dent in your credit card, et cetera, et cetera. So if you kept your income, as lockdown eases, you might actually have a little more cash in that bank account than you normally do. And to your point, if you then take that you only live once, let's spoil myself, that money that hasn't disappeared is perhaps now rushing out into the broader economy.
Yep. And I think there's also a sense of people realizing that they are more important things to spend on. So it'll be interesting to see. And again, you've corporates, as you mentioned, you've got corporates. So worth also just noting for South Africans, and this the NAMSA data we get is when things do pick up, is it going to be corporates or hiring companies, car hire companies? How quickly is that actually going to bounce back? Thinking specifically because, as somebody who doesn't have a car, we were chatting before the webinar started about the fact that, I now have to, towards the end of the year, take a trip down to KZN, which means I'll have to hire a car. And, how many of those people who are going to be taking trips across the country, what benefit will it really be for car hire companies? So there's a lot to sort of think about and look out for in this cycle. And it'll be interesting to see how quickly or how slowly or how how predictable or not that recovery will be.
Yes. No, agreed. Yeah. Sorry, over to you.
Yep. And then moving on, or moving back rather, to the US. So stimulus conversations still ongoing, lots of noise about it, lots of uncertainty, obviously. I think, there's a lot of battles and a lot of things leading up to the to the election where, there's just some conflicting interests around, the stimulus package for, the US. But perhaps let's just touch on, for investors, what do we need to be thinking about or looking or considering about the US stimulus package that has been proposed?
Yeah, so President Trump signed some executive orders, but there's a lot of dispute as to how that works. I mean, basically, we need Senate and Congress, the House, to sign a bill. The two parties are far apart. They're also currently on break. Nancy Pelosi has suggested that they should come back early. Yeah, and we've been watching this since mid-July when I started saying, will it happen? And we're now 2 weeks into August where the checks haven't been getting sent, and people are struggling, but they can kind of pick it up. They'll manage in a sense, and that's a horror thing to say, but there's still significant swaths of unemployment. The US is still at or around record levels of unemployment, and even at around 10%, it is giant numbers. And in order to sort of keep the economy going, we need it there. And it's really quite simple. The bigger the stimulus checks, the more money into the US economy, the quicker it'll get back to December 2019 levels, and the better overall for the economy, for the populace, and ultimately the market, the non-tech market. Tech has obviously been doing great, and the smaller those checks, then the harder it's going to be. And it seems to be the divide is between 200 and 600. 600 is what we were seeing already. 200 is the proposal from Republicans. Democrats want 600. I think they'll probably settle somewhere around the 400 or 500, which is fine. That then keeps the economy going. If it comes in, or if they're unable to find any sort of consensus, it really starts to put that slow recovery we were talking about a moment ago under threat, and starts to say it's actually going to be slower and even longer than we would otherwise expect. So it's an important point to keep an eye on. And I know that these checks are over and above usual unemployment benefits paid out in the US, but it's a pandemic. Things are unusual. And usually in a household where you've got perhaps two earners, you might lose one job, but there's still the second earner, and it's very tough when one job goes, but you can kind of manage. The scenario during the pandemic is many households actually lost all income, and all they get is government unemployment and stimulus checks. So they're playing an outsized role in the economy and ultimately the recovery as things stand right now.
Yeah, and I think it's quite interesting, Simon, that you bring up the how far really one can go with the stimulus check. And I think what I've certainly seen and been reading, especially, and it's sort of anecdotal evidence in terms of you read one person's op-ed piece about how they're waiting for money because they just don't have any. But it also just I suppose brings the what's happening on the ground into full focus. And we've had these conversations around South Africa proposed packages where it's like, really it's how far can 350 rands go? How far can 600 or 700 or $200 go? It's not a lot, but it's not, that's not money that's enough to keep somebody living in, if they're renting, or enough to keep them paying their bond or whatever the case might be. However, when you've got people who are, for the first time in a very long time or ever in their life, are facing a place where I have no food. There's just no food. My children have no food. It really brings the severity of the situation we find ourselves in. And I suppose we could always argue that for some people this has been a lived reality for a very long time. But I think when you have it at such a grand scale, it becomes a very, very big problem. And I think you need to think about the implications for the economy when you've got more and more people who are homeless, more and more people who are relying on social security benefits, so over and above the stimulus check. And the impact and the weight that carries and bears on the economy. So I think there's going to be a lot of lessons in these sort of changes that we need to be keeping track of.
Yeah.
And seeing how it changes the face of the US economy and the global economy, I suppose.
Yeah.
For all intents and purposes. But yeah, moving on to stocks. So Tesla, we touched on this 2 weeks ago. That they're going on a stock split, or share price split journey, and they've proposed 5-1 through a special dividend. Can you just talk us through what this actually means? And I suppose for anyone who may be holding Tesla stock through the web trader platform, what this might mean for them.
Yeah, so in essence, if you hold one Tesla share and they do the 5-for-1 split, you will end up holding 5 Tesla shares. And if Tesla's currently trading at, let's say, I'm going to call it 1,500 because it makes my math easier, the Tesla share price will then drop to 300 per share. So it doesn't change market cap or anything like that. None of those details change. The logic behind it, and back in the olden days, and I'm going back to the 90s now, you used to have to buy shares in lots of 100. So if a share was really expensive, that became a problem. You could do odd lot transactions, but they were difficult to do. Now, of course, with electronic, that's no longer applicable. Yes, but like Naspers now, 100 Naspers shares, that's beyond the realm of most people. That's 300,000 plus. Most people can't do it. So you would do a share split. Now we can buy a single Naspers share. In this case here, I think Tesla's saying, you know what, $1,650 is a giant price. Let's do the split. That'll bring it down to $350 a share. And then it'll make it more attractive for sort of the smaller investor. And that's not totally, that's fair enough. There are some brokerages in the US that offer fractional trading. Most don't, but it is purely cosmetic from that sense. But what it does do is it is typically bullish for companies. Consolidations are bearish, and stock splits are bullish. There's no fundamental reason, but there's a psychological reason behind it. And certainly we can see Tesla currently trading at all-time highs, and will probably continue to trend upwards in the days post the split, and then sort of normal market conditions can kind of start taking into account again.
And I suppose, Simon, I think the very big thing, and it's been something that Elon has sort of been taking a jab at. But when you have these scenarios where there's a stock split, or share price, stock split, but what happens with short sellers? Because short sellers have obviously been railing against this, but what's the impact for the short seller?
So, the only real impact is that you were short one stock, now you're short 5, and when you return the script to whoever lent it to you, they're going to want 5 returned instead of just 1. So again, the impact is truthfully nothing, except of course that the shares are rallying on the news, so short sellers are once again being hurt. And we're looking at the price here on the screen, a PE ratio of 850, but no one buys Tesla on their PE. Truthfully, it's been priced as a tech company, and you can make an argument, and it's up to the individual whether they buy the argument or not. You can make an argument that Tesla is a tech company in terms of autonomous driving, and that more than anything, that will be their future, because electric vehicles in our lifetimes will become a commodity, but autonomous driving will perhaps be the edge in vehicle travel going forward.
Thanks, Simon. And then lastly, Airbnb, surprise, surprise, filing for an IPO this month. And I think, the timing is so interesting for me because you've just come out of pretty much like the whole world not traveling. And, they've obviously gone through their issues with the lockdown, having to, get rid of a quarter of their staff to, obviously in order to cut costs. They're obviously going to be having a lot of pullback in terms of revenue, so many losses. But I mean, you still got a valuation of like $18 billion US. I think when the noise around, or the last time we heard the noise around an IPO for Airbnb, it was about 31 billion US dollars. So that's quite a big cut. But again, and we've spoken about this, these valuations that are sort of based on rather shaky fundamentals. But what are your thoughts? I mean, I would have thought, maybe hold back just like another until like mid 2021.
Yeah, I don't know with you 100%. I would have held back if I were Airbnb. I suppose there is some pent up demand. I was looking at timeshare, and a week ago there was thousands of units in South Africa, and by the time the president spoke on Saturday night, boom, they were all gone. So some pent up demand, but maybe waiting a year, and perhaps there's some of the funders and the VCs who are pushing them to it. Perhaps they're worried that it'll get even a lower price. Truthfully, Airbnb is a business that I like. I consider it to be much more stable and less exploitive than the likes of Lyft and Uber. I think it really works. I think it's got a very viable business model. It certainly has some challenges in the US. Mansions being rented for parties, but again, those make the headlines and probably aren't the norm. They happen probably fairly infrequently, in truth. So I'd like the business case for it. The pandemic passes in time, we all hope, and sort of the new reality sets in, and Airbnb can sort of pick up on that. I think there has been a lot of shakeout. I know people who, personally in Cape Town, but also reports out of the US, who had picked up 6, 7, 8, 10 apartments, and then suddenly got no revenue for 3 months, and it all just collapsed. So there's undoubtedly been some shakeout from it, but broadly as a concept and a platform, I like Airbnb, and I'm interested in. It's always what always matters is the pricing, what their sort of revenues are during the pandemic, etc. But at the right price, this is, for my mind, an IPO that's worth having a look at.
So, Simon, I suppose I have two things that perhaps I can see certainly Airbnb incorporating. The first is in terms of mansions and whatever. What now they've done is first they've introduced like a new luxury, Airbnb Lux, and you can rent a mansion for like 12,000 US dollars a night, but minimum period that you can stay. There's all sorts of stringent, I suppose, requirements and things that you need to fulfill. Having watched at some point during lockdown, I went through a period of being obsessed with renovation shows and some of the things that even hosts are putting in. So like noise monitoring, you for $12,000 a night, you get to have a butler, and obviously when your butler's around, you're not going to misbehave. That 12,000 also covers a whole lot of insurance, so in case you do have the party, you're able to fix your apartment. So I think we're going to see a lot more of those sort of models where people are taking more active interest in sort of putting together monitoring tools to be able to make sure that their properties are safe. But on the other hand, I'm actually wondering if this safety might look at incorporating into their business model, because then, you're offering people some sort of security, especially when it comes to income, but you're also not doing it sort of flying blind. Obviously, you need to have the right minds and smart minds to be able to build a model that's viable. But do you think this would be something that they might actually end up considering?
I think so. I think your idea around sort of a pandemic fund, and even though we hope this is the first and only of our lifetime, there are other issues. I mean, just take floods, take perhaps political unrest in an area, and suddenly bookings are being cancelled, insurance and the like. I also know that the reports were, and these go back to last year, that Airbnb was looking at different ways to support some of their hosts. One example, if you wanted to take your property off grid, they would greenhouse off grid, etc. Gets you better traction, maybe gets you better bookings. They were looking at doing loans for people who simply wanted to just upgrade the furnishings and that sort of thing. So I think Airbnb can become a lot more sort of important and a lot more helpful in the host's lives. There is again the flip side. I know the apartment block I live in has banned it. People decided they didn't like it. I truthfully didn't mind. I thought having weird different people in the complex all the time was actually interesting, and meeting some different people. They've certainly seen pushback from cities and the like. But as someone who used to back in the day travel a fair bunch for work and for holiday, my work I stuck to hotels. I wanted the convenience, the ease, and everything else. But my leisure travel absolutely moved to Airbnb, and it's a great model that does work. And I think there's a ton that they can do to really innovate in the space. They started doing things in terms of, if you're going to a certain city, they start offering you things to do, and particular tour guides, and making it more than just this is where you book your accommodation. And as I say, I think that a lot of the innovations that have come out, you wonder, how do they survive? Are they still, they're here in, Uber and Lyft, are they here in 10 years? Sure. How do they look? Probably quite different. I'm not sure how, but surely they look quite different. I think Airbnb is different in 10 years, but probably different in ways that is significantly beneficial to both hosts, users, and ultimately shareholders when they do IPO.
Thanks, Simon. And now moving locally, perhaps let's start first with the fact that we're on level 2, and then we'll dive into some of the results. But we're finally on level 2. As we said at the beginning, we can travel, we can take little holidays, interprovincial travel is open. International travel, not quite, except I believe for international business flights. And I think there's particular T's and C's. And I say this as well because somebody I know, actually, that a former colleague, has moved to the Netherlands, and they flew out last night.
Okay.
Go to the Netherlands. So they're immigrating, and I was a bit like, oh, I didn't realize, flights were open, people could go places, but I think with special arrangements,
I know some people who've been repatriated. A friend's brother was in Thailand, and he got repatriated. So there is some flying happening, but not for me and you, I suspect.
No, definitely not. But we're at level 2. We're hoping that all the scary things that we've seen in terms of the economy just getting back to normal, or the new normal, we'll be able to do that. But, there's been a lot of debate about level 2. There's been a lot of debate about, allowing the sale of alcohol, etc. And, people concerned that we'll get back to level 5. Personally, I don't believe we're ever going to get back to level 5 lockdown. It's not viable. Or level 4, probably maybe level 3 or degrees of level 3. But I really don't see us going back into a full, sharp, hard lockdown. It's just not going to happen. But yeah, maybe let's just chat about some of the concerns, some of the yays, and some of the industries that we're likely to see a lot more positive news on. Level 2.
So, obviously your industries, the leisure sector, which has just been shut down 100%. There's been a little bit happening, but, intra-provincial opened a few weeks ago. Now we can leave the provinces. As I said, I saw RCR with timeshares massively booked up. I was looking around at other places, and certainly there was a ton of capacity and a lot of deep deep discounting. I'm seeing discounting of up to 80%, and that was still this morning. In other words, even with the new travel, and that's the point. Sure, there's a lot of pent up demand. We haven't taken a holiday in 5 months, but there's a lot of options for where we go, and there's still concerns because there's still a pandemic out there in the streets of, well, not just South Africa, the streets of the earth. But what we did see this morning was a number of stocks initially really moved strongly. Distell, one of them, and Distell's an easy win, right? Because alcohol sales can almost on a dime go back to normal. The sales that have been lost are gone, but they can return back to normal. So Distell's actually had a good week. Last week it added some 10%. It popped this morning, although I see it's pulled back a bit. And I think at these sort of levels, they're probably going to earn R5.50 for the year ending June 2021. Put some in a PE of around 12 or so. That's not bad for Distell. They're going to do a little bit better thanks to a weaker rand. They export into UK and Europe. Their higher end brands will probably suffer a bit, but their sort of mainstream middle LSM brands, those sort of levels will go back. Your likes of Sun International, Soho Sun and the like, I think it's going to be a while. I think, Sun International will now, initially they didn't reopen it because it was in the Northwest. So whilst me and you could go on holiday, the only people who could go to Sun International were those in Rustenburg. So it'll open, but conferences, big events, those are still limited to 50 people. There's not going to be live shows and the like happening. So I think those are going to be very, very slow. And if we touch quickly on City Lodge, the nil paids, I think the nil paids are still trading today. Am I correct on that? Yep, they're still going through. Those nil paids, today's the last day. I was running some numbers on City Lodge. So at what price point does City Lodge break even? What occupancy levels? And I very, very rudimentary back of a matchbox. I used the numbers to June 2019, and basically at about 35% occupancy, City Lodge is at break even before interest, tax, depreciation, and amortization, BEE, and all those other sort of costs. So it's really your EBITDA type of number. And there's lots of holes in that. The question, and City Lodge is 35%, we can probably say that for the hotel groups broadly it's going to be about the same for Sun International and Soho hotels, etc. And how quickly do we get back to that 35? And I got to say, I can see us getting back to 35 maybe by the end of the year. I don't see hotels getting back to plus 50 in the current sort of, financial years running till June 2021. I think they're stopping to lose money perhaps, but I don't think they're going to become giant profit centers just yet. And that's the concern. Some tempered expectation. Spur starts to win a bit, but even that share price not so thrilling. Famous Brands, hold on, too many F's there. Famous Brands has been running, but you can see today, if anything, that's actually a reversal candle from a technical perspective, because we can now have drink when we go out for dinner, although by all reports, we were out eating in Johannesburg, you were being served wine and beer and teapots and mugs and everything else. I haven't been to a restaurant since March, so I have no clues to it. But I think we've got to temper our demand. It's still, caution from people. There's still a pandemic out there. Consumers under pressure. There will be some initial pent-up demand coming through, but I think there's a long way from sort of robust profits. The exception, I really do think, is Distell, who I think have got, I think alcohol sales, we've lost them, but they come back. Quick last point on that losing sales. If you've lost a holiday sale, and it's what we said earlier, if you didn't lose your income and you didn't go on your June holiday to Durban, for example, which I missed my annual winter's holiday to Durban, I do just push that holiday out. I will still have that holiday. I'll just do it later in the year, and I'm looking at last week in October. So that money will be spent. But that is again for people who haven't lost income, for people who are confident of retaining their income. So it's going to be, I think, the leisure sector. We're seeing a massive pop. I mean, even Brait, who owns Virgin Active, has been flying on theories of the Virgin gyms opening, because of course I haven't paid my gym fees since March. They just haven't been charging. But I think it's going to be sort of very slow rather than any sort of exciting pop for most of these leisure stocks.
And I suppose on that Brait and Virgin and fees, etc. One of the concerns is, I suppose, from an investor's perspective, is I'm waiting for Virgin to start taking money from people's bank accounts. However, how many people are actually going to cancel their accounts? And
Yeah.
how viable really, or how bound are they to the clauses or the account closure clauses? Because I know there's like a penalty if you close your or terminate your contract too early, etc. So just thinking about that, the balance between, do I just carry on with the debit order, or do I pay the penalty fee and just close it?
Yeah.
So these are the questions the investors need to be thinking about.
Absolutely. And in fact, so an interesting point on Virgin Active is that, and I don't know about other gyms, but Virgin Active, so they weren't billing. I haven't paid since the one at the end of February. And you know what? Kudos to Virgin for that. But it did endear me to not otherwise hate them, because I can't use your service and you're still taking your money. But what they did say is that your time on your contract has been ticking over. In other words, your contract is now considered to be 5 months older, which means all of our contracts are 5 months closer to expiring, or your contracts actually expired during lockdown. Now, exercise is one of those things, it's a habit, and it's a hard habit to get into. And I wonder how many people, after 5 months of not being able to go to a gym, perhaps don't. And then when it expires, they're like, oh, well, I've stopped going to gym. Now, from a health perspective, that's terrible. But, let's be frank, we're human beings here. I know I do swimming, and I have desperately, we were talking before we came on air, I was at Emerentia and I saw the lake, man, and I wanted to jump in my costume in the water, notwithstanding it was 6 degrees water. But I've really missed my swimming. I'm really, really, and in winter I swim indoor in a heated pool. I avoid the open water. That kicks off in spring. But I still don't know, as much as I've missed my swimming, I still don't know if I want to go back to a gym just yet. There's still a pandemic out there. And maybe I'm a coward, but whatever it is, I'm not the only one out there. So I think a lot of this, Brait in particular, has really run ahead. It was very much a buy the rumor. Last week, all the talk around the president's going to lift the restrictions. Now he has, the second rule of buy the rumor is sell the fact.
Yep. And I think, it'll be interesting to see, as we take this recovery and going back to, in inverted commas, normal, how it plays out, really.
Yeah.
And I mean, I've started running again, but again, I run. I don't go to a gym because I just don't like the idea of my money being taken. But it's, I think it'll be interesting to see how many people actually get back up onto that. Although, if we look at how many people have suddenly taken up hiking and, just all manner of outdoor activity, I think we might actually find that, like New Year's resolutions, you just have that initial sort of, if maybe not an influx, but just signing up of people who've, I don't know, had a, moment during the lockdown of realizing that, wait, hang on, I need to take better care of myself, and gym is the way to go.
Yeah.
And I'll have social distanced sessions with a personal trainer, or whatever the case might be. So it will definitely be interesting to see how, that plays out in the real world. Just in the interest of time, looking at now Sasol, annual earnings down 61%, obviously impacted by oil price, plenty of write-downs, and just having to really just cut a lot of the value on a whole lot of assets that they're really trying to get rid of. Obviously, Lake Charles still a very, very big part of that. Also, news about a rights issue, but being pushed out, so unlikely to happen anytime soon. We're probably looking next year. But for investors, because this has been a really hot stock, for a number of months. What are we really thinking about? And there's been mention of like a new Sasol, so to speak, without much detail about what it entails, except maybe some hectic cost cutting. But like, are we talking new as in green energy new Sasol? What exactly are we saying when we say, new Sasol?
So
What are your thoughts?
you
Simon?
touch on a great point there. I think Sasol and Exxaro, just to quickly go down that rabbit hole, have missed a point. I missed a trick. I think 10, 20 years ago, they should have both started pivoting into clean energy rather than coal and oil. Those hydrocarbons, etc., are not the energy of the future, and they could be halfway down that road. So the Sasol numbers. So if we look at the charters there, basically it broke the trading range. It sucked everybody out on the in the upside, and now it's just back in that trading range. The numbers in of themselves, yeah, okay, write downs, we get all of that. That's not new anymore. To me, the big story was the rights issue. They're talking about second half of the financial year, which means first 6 months of next year. They're still talking about up to 2 billion. In other words, they didn't give us any more clarity. They obviously know further down the line on selling some or some of Lake Charles and the ethane cracker plant. There's been lots of rumors out of Korea around Korean companies that are interested, but the prices, they needed to write down the value of Lake Charles to make it work, because no one was going to pay for what ended up being a massively overrun cost business. Where is Sasol right now? They remain in a tough space. And let's touch on that cost saving. So they're selling their oxygen unit at Secunda to a French company. And that's great. That generates them a whole bunch of cash to help pay down debt. But essentially, that was an area which they were the only customer. So what that means is now when they use those oxygen units, they actually pay a higher fee, because now somebody else owns it who wants to make a profit. So they're doing short-term gains for longer-term pains. And that's sometimes where a company finds itself. It's very much a case of where Sasol finds itself. And I think very much Sasol's back into that sort of 130 to 150 trading range. I think it's going to carry on flying around there until we get some certainty on the partial disposal of Lake Charles ethane cracker, and that will then give us some idea of the rights issue, which, as they said, there's still a potential $2 billion rights issue on the table, which will be the biggest rights issue in the history of the JSE. So I think market is kind of absorbing the results and saying, fine, but we need those bigger issues resolved. And I think that probably isn't going to happen anytime soon. It'll happen over, at some point in the next sort of 6 months, so taking us through to say April of next year, maybe February of next year, we'll get some clarity. But those negotiations are obviously happening slowly, and that's the certainty that the market really needs to then decide if it's a good deal, in which case move higher, or a bad deal, in which case move lower. Otherwise, if you're a trader, trade that 130 to 150 range. The rest of us sit and watch.
Yep, we on the sidelines who've missed the very great trick upwards. And Simon, just quickly looking at Richemont saying they've got a dividend coming out, a loyalty dividend, warrants.
Yeah.
That's a very interesting method of disbursement. But can we quickly just touch on what exactly is a warrant, and then then look at the strategy and why it is or isn't a good idea?
So Richemont's obviously trying to save cash, which is a bit weird because they've got 2.5 billion euros on the balance sheet, and then they raised another 2 billions in a euro bond at I think 1.25%. They got plenty of cash, but they're scared about the future. Not unfair. Luxury goods, pandemics, not good. So what they did was, instead of passing on a dividend, which is what most companies are doing, or issuing shares in lieu of a dividend, they're issuing a warrant. Now, a warrant gives you the right to buy a share on or before. In the case of this one, it is a European, so it lasts for 3 years. So in September 2023, you can take your warrant and buy Richemont shares. I stress the buy part. You don't get them for free. They will trade on the market, so you could sell them between now and then. Call me old-fashioned. I like my dividends in cash, or maybe a script option, but give me cash. If I want script, I might take it, but I might also just prefer the cash so I can do with it as I want. Running the numbers, and I stress these numbers are from Nick Kuntz on Twitter, who's way smarter in this than I am. His numbers say quite simply that if Richemont goes up 50% between now and September 2023, you will ultimately get a return of around 2% on your warrant. In other words, it's not a great investment. And as a shareholder, you don't have a heck lot of choice in this scenario, but I really think it's the Ruperts being... I don't know why they're doing it. I don't know why they just didn't say, you know what, guys, like there's a pandemic, like luxury's hard, like please can we come back next year? We'll look at a dividend then. Can we skip 1 year's dividend? I think, first pandemic in 100 years, I think the market would have forgiven them skipping one dividend. Instead, they're going with the warrant. So if you hold Richemont on the last day to trade, you will get warrants appearing in your online share trading account. You can sell them whenever you want, or you hold them until September 2023 when they will expire, and you then have the right to buy new Richemont shares.
Thanks, Simon. And I suppose, lastly, just looking at Capital County's results, a property stock. Again, in an environment that is very, very tough for the property sector, what can we make of these results?
So the results weren't a horror show. We've certainly seen some horror show results. Capco weren't a horror show, but they their loan to values in the low 30s. That's fine. Earls Court remains one of the prime assets in the world. Covent Gardens. They fairly well positioned. They had problems with rental collections, no surprises. They are an outdoor venue mostly, which the World Health Organization will say, if you're going to go out, stay outdoors. It's, wear your mask, social distance, and be outdoors is your safest environment. I just can't get excited about it. I think that it's still tough. They still have Brexit. They still got lockdown issues around it. I looked at those results and I thought, not bad, but not enough to make me want to rush out and buy them. I think we need to still hold off. My sense property is you really want to go into the more niche properties. And by that, I mean logistic players. Locally, that's Equitas. The medical property, in other words, who own the hospitals, data centers. I think sort of the traditional property, office, residential, retail. For me, let's be careful there. Let's be cautious. Much like the leisure, a lot of those shops might get back to break evens, but it's a long way to profit. We're still going to see bankruptcies and businesses going out of business, and we're still going to be seeing that lower. Who's a person who, during a pandemic, is going to decide to open a new business and rent some space, either commercial or retail or something? That is they exist. They absolutely exist. But they are exceedingly brave people. Most people are going to open a business when times are good and flourishing. So property remains tough. And as much as those Capco numbers weren't as bad as I thought, they weren't enough to make me want to have a long, hard look. Never mind to put some of my hard-earned randellas at them.
Thanks, Simon. And then finally, to close off, Blockbuster getting a new lease on life, I suppose, or rather breathing its last really before closing. It's pretty much the last store, not pretty much, it is the last store. And they're offering a sleepover, sort of like a slumber party vibe. For a couple of people, 3 nights only, and you get it for $4, which is Wow.
and free pizza. I could eat $4 of pizza, but I don't know about you, Dino. I hated going to the video store on a Friday evening and trying to find a video. It was a painful experience. We could never agree. What you wanted was never in stock. I'm a streaming Netflix. But hey, for all the pizza I could eat, I would do the $4.
I would absolutely do so too. Although, I mean, and I'm glad they're taking precautions, but I don't know if I'd do it right
Ah,
now during a
yes, yes.
global pandemic, but in any other time,
Can I book for August
yeah,
next year?
yes, except it'll be closed already. But thank you, Simon, for joining us as always, and thank you to everyone. Please stay safe as the economy opens up and there's a lot more movement. You know, it's a sage reminder that just because we're easing restrictions doesn't mean the pandemic is over. So just please be very careful, take care of yourselves, stay safe. And Simon, we will chat next week.
Yeah, Dino, have a great week. We'll chat next.
Thanks everyone, and stay safe. Goodbye.